The world of finance can feel like a jungle. Dangerous, unpredictable, but full of treasure if you know where to look. Trading isn't just about making money, it's an adventure that can change your life. But before you go swinging through the jungle with your wallet, you need the right map. And that map is the trading terms we're about to break down. So let's start simple. Trading means buying and selling financial assets, stocks, bonds, currencies, commodities, to profit from price changes. Buy low, sell high. Or if you're bold, sell high first, and then buy low later. It's basically Black Friday shopping in reverse. Stocks are slices of a company. Buy Apple stock, and you're a tiny part owner. If Apple sells a new iPhone like crazy, the stock price can go up. Bonds are IOUs. You lend money to a company or government, and they promise to pay you back with interest. Less exciting than stocks, but safer, like being the bank instead of the gambler. Forex is the global currency market. Think of it as one giant money exchange. If the euro rises against the dollar, traders can profit. It's like betting which country's money is hitting the gym harder. Commodities are physical stuff. Gold, oil, wheat, bad weather, wheat prices spike, geopolitical drama, oil goes crazy. Now every trade has two key prices, bid and ask. The bid is what buyers are willing to pay. The ask is what sellers want. The difference is the spread. Tight spread? Market is liquid, like Costco on a Saturday. Tons of buyers and sellers. Wide spread? More like a yard sale in the rain. Awkward silence, nobody around. Liquidity means how quickly you can buy or sell without moving the price too much. Apple stock? Super liquid. A rare Pokemon card? Not so much, unless your buyer is a die-hard collector. Volume is the number of trades happening. High volume is like a packed football stadium. Lots of action, lots of energy. Low volume, like a high school chess club. Quiet and slow. When you place a trade, there are different order types. Market order, I want it now. You buy or sell immediately at the best available price, like hitting buy now on Amazon. Limit order, I only want it at this price. You set a limit, and if the market reaches it, the trade happens. If not, no deal. It's like waiting for that sneaker to drop in price before pulling the trigger. Stop loss, SL, your safety net. If the price drops too far, the system automatically sells to protect you. Think of it as a seatbelt. You don't want to use it, but when the crash comes, you're glad it's there. Take profit, TP. The opposite. When your trade hits your target price, it sells automatically so you can lock in your gains before greed kicks in. Now let's talk about the candlestick chart. Those green and red bars everyone loves. Each candle shows how price moved during a time period. Green candles mean the price closed higher than it opened. Bulls won. Red candles mean bears pushed it down. Sometimes you'll see funny shapes. Doji. Price opened and closed at the same level. Basically, the market can't make up its mind. Hammer. Looks like a hammer at the bottom of a downtrend. Bulls are fighting back. Shooting star appears at the top. Bears are smacking the price down. Candlesticks are like little stories of market psychology, drawn in red and green. Next, support and resistance. Support is the floor. Every time price drops to that level, buyers rush in and push it up. Imagine a property that was once $100K. Price drops back to $100K years later. Buyers jump at the discount. That's support. Resistance is the ceiling. Every time price climbs up there, sellers dump and it falls. Think of investors who bought the top and are just waiting to break even. Once price reaches that level, they sell to escape. That's resistance. Moving averages, MA, are tools to smooth price trends. The 50-day and 200-day averages are popular. If the 50-day crosses above the 200-day, it's called a golden cross. Bullish. Crosses below, death cross. Sounds scary, but traders love it. RSI, Relative Strength Index, measures momentum. Above 70, market is overbought, could cool down. Below 30, oversold, maybe time for a bounce. Don't treat it like gospel, but it's a handy gauge. Now here's the big lesson. Trading isn't about being right all the time. You can be wrong more often than right and still make money if your winners are bigger than your losers. That's why risk management is king. Stop losses, proper position sizing, and discipline. That's how traders survive long-term. To wrap it up, trading is a game of probabilities, not certainties. The terms we just covered, bid, ask, spread, liquidity, volume, market orders, support, resistance, moving averages, RSI, they're the language of the markets. Learn to speak this language, and the charts start to make sense. And maybe, just maybe, you'll spend less time panicking and more time profiting. If you found this breakdown helpful, hit like, share it with a friend who still thinks RSI is a brand of car, and subscribe for more trading lessons made simple. Because trading doesn't have to be rocket science, it just has to be explained right.